Two investors, same 7 funds, $1.2 million apart. One held them in a Roth IRA. The other held identical shares in an ordinary taxable brokerage account. 30 years later, the difference in what each investor actually keeps runs close to $1.2 million. Not from picking better funds, but from where those funds were parked. That gap is the cost of one silent mistake. Put the wrong assets in the account that never taxes them again, and you hand back a 7-figure gift the tax code was quietly trying to give you. Most people do exactly that. They fill their Roth with safe, slow, tax-friendly holdings and leave the tax-hungry ones exposed everywhere else, optimized backwards without ever knowing it. So here is the question this video answers. If every ETF grows tax-free inside a Roth, why do only 7 belong there? And why, once placed, are they almost never sold? The math is coming, dollar by dollar. Because the difference wasn't the funds, it was the account they lived in, and why that account rewrites the whole list. A fair objection lands here before the ladder even starts. A good ETF is a good ETF. The reasoning goes, a low-cost, total market fund compounds the same way no matter which account holds it. So why would the wrapper change anything? The fund doesn't know where it lives. The shares don't behave differently because of the account number printed above them. That objection deserves its strongest form, not a straw man. Inside any tax-sheltered account, a Roth, a traditional IRA, a 401k, the growth itself is invisible to the IRS while it compounds. Dividends reinvest untaxed. Capital gains from rebalancing trigger nothing. So at first glance, the account looks like neutral scenery. If nothing gets taxed on the way up, the argument runs, then placement is cosmetic, and any decent portfolio works anywhere. Here is where the reasoning breaks. The Roth is not merely tax-deferred like its cousins, it is tax-free on the way out. That single difference changes the math, because the exit is where assets are ranked by how hard the tax code hits them everywhere else. Think in terms of what economists call the tax drag on an asset. A broad stock index fund throws off modest qualified dividends and rarely realizes gains. In a taxable account, its annual drag is small, sometimes under 0.5%. A high turnover growth fund, a REIT spinning off non-qualified income, a fund that kicks out ordinary income distributions, those bleed 1, 2, sometimes 3% a year to taxes in a brokerage account. Same market, wildly different friction. Now apply the wrapper. The Roth's tax-free forever rule is worth the most on the assets that are punished hardest outside it. Shelter a tax-efficient index fund, and you've saved a rounding error. Shelter the high-drag, income-heavy, high-turnover asset, and you've eliminated a 2% annual leak, compounded across 30 years. The account doesn't change the fund. It changes how much each fund is worth having in there. That is the inversion. The instinct is to protect what feels precious. The safe holdings, the bonds, the blue-chip dividend payers, inside the account that never taxes them. But those are precisely the assets the tax code was already treating gently. Municipal bonds are tax-free in a taxable account by design. Qualified dividends already enjoy preferential rates. Putting them in a Roth wastes the shelter on something that barely needed sheltering. Meanwhile, the assets that scream to be protected, the aggressive growth engine, the international dividends taxed twice, the REIT income taxed as ordinary income, those often get left exposed in the brokerage account, paying full freight every single year. That is the backwards Roth, not a bad fund problem, a right fund wrong room problem. So the answer to the objection is precise. A good ETF is genuinely a good ETF everywhere. Its returns don't change. What changes is the after-tax return, the only number the investor actually keeps. After-tax return depends entirely on how much friction the surrounding account removes. The Roth removes the most friction from the assets that carry the most. This is why the ranking flips. Ask not which ETFs are best, but which ETFs lose the most to taxes elsewhere and therefore gain the most from a wrapper that never taxes them again. That question sorts the entire universe of funds into a different order than most people expect. Which means the 7 that belong in a Roth are not the 7 a nervous investor would instinctively choose. They are, in a sense, the opposite. And once the list is reordered by tax drag rather than by comfort, The build acquires a required first rung, a foundation everything else stacks on. Most people, reaching for the exciting funds, skip straight past it. Reorder the universe of funds by tax drag, and the first fund on the list is the least dramatic one you own, not the high flyer. The floor, a total U.S. market ETF one fund holding roughly every publicly traded American company, from the trillion-dollar names down to the small ones, is the foundation rung, and it goes in first for a reason that has nothing to do with excitement. It goes in first because it does the one job the whole ladder depends on. It makes the account impossible to break. A total market core doesn't need to be timed, rebalanced, or second-guessed. It captures the entire domestic market's return with near zero turnover, which means even in a taxable account it barely leaks. That is the quiet paradox of the foundation. It is the most tax-efficient asset the investor owns, and it still belongs in the Roth because it is the anchor everything else is measured against, and because a Roth with no core is a Roth with no gravity. But notice what a total market fund is not. It is not the reason the tax shelter exists. Here is the contrast that defines the second rung. The foundation is built to survive. The growth engine is built to compound violently and to get taxed brutally everywhere else. This is the layer of aggressive, high turnover growth. Funds tilted toward companies reinvesting every dollar back into expansion. Funds that trade more, distribute more, and in a brokerage account bleed the most to taxes every single year. Outside a shelter, a high turnover growth fund can surrender 1 to 3% annually to short-term gains and ordinary income distributions. Inside the Roth, that leak drops to zero. That is the whole point. The account was designed, whether the tax code intended it or not, to protect exactly this kind of asset. The higher the internal friction a fund generates, the more the tax-free wrapper is worth wrapped around it. So the growth engine isn't in the Roth despite being volatile and tax-hungry. It is in the Roth because it is volatile and tax-hungry. Comfort would place it last. The math places it near the top. Run the two rungs side by side over 30 years, and the logic sharpens. Picture a composite investor. Call her the archetype of someone doing everything right. She puts the calm total market core in her Roth and, feeling responsible, leaves her aggressive growth fund in a taxable account where its yearly tax drag compounds against her. Her neighbor does the reverse, growth engine sheltered in the Roth, tax-efficient core held in the brokerage where it barely bleeds anyway. Same two funds, same market, same 30 years. The neighbor keeps more, not by a rounding error, but by a meaningful slice of the eventual $1.2 million gap because he sheltered the asset that needed sheltering and exposed the one that could absorb the exposure. The first investor protected what was already safe. She did everything right and still built her Roth backwards. So the foundation and the engine are placed. Two rungs down, and already a pattern is visible. The ladder is not sorted by how much a fund excites its owner, but by how much of it survives contact with the tax code outside the shelter. Which raises the question that governs the rest of the build. There is one layer of this ladder that almost everyone assembles in the wrong order. Not the wrong fund, the wrong sequence, and it quietly costs them years of compounding. That failure is coming, but it is not either of these two rungs. Because before the mistake, the ladder has to reach past the borders of the United States. With the engine placed, the next two layers decide how much of the world the Roth actually owns. Two rungs in, the ladder is entirely American. And that is the quiet limitation nobody notices while the domestic market is winning, because a total market fund, for all its breadth, still stops at the water's edge. It holds every U.S. company and not a single foreign one. The engine compounds, the core anchors, and together they own exactly zero of the roughly 40% of global market value that sits outside the United States. A Roth built only of American funds isn't diversified. It's concentrated in one country that happens to be home. There is a reason this matters beyond geography, and it runs straight back to tax drag. International stocks pay dividends, often generous ones, and those dividends carry a second layer of tax that domestic funds don't. Foreign governments withhold tax on dividends paid to American investors before the money ever arrives. In a taxable account, an investor can often reclaim some of that through the foreign tax credit. Inside a Roth, that credit is worthless. there's no U.S. tax to offset it against. But the withholding on a broad, developed and emerging international ETF is modest, and the far larger benefit is that every reinvested foreign dividend then compounds untouched by the IRS for the rest of the investor's life. The third rung, then, is a total international ETF, developed and emerging markets in one fund, sheltering income the tax code treats as ordinary everywhere it can reach. History gives the argument its teeth. Consider the lost decade, the stretch from 2000 through 2009, when the S&P 500 delivered a negative total return across 10 full years. An investor who owned only American funds watched a decade evaporate. International and emerging markets, over that same span, posted meaningful gains. The point isn't that foreign stocks always win. They don't. The decade that followed reversed the leadership entirely. The point is that a portfolio holding both never depends on which region happens to be favored, and the investor who abandoned international exposure after 2009's disappointment forfeited the diversification precisely when it had just done its job. That parallel sets up the fourth and fifth rungs. Small cap and emerging market tilts round out the latter, and they earn their Roth seat on the same logic as the growth engine. Small company stocks are volatile, higher turnover, and historically carry a return premium bundled with sharper swings and heavier distributions. Emerging markets add currency movement and the highest dividend withholding of all. Both are, in tax terms, high-friction assets. Both bleed the most outside a shelter. Both, therefore, belong inside the one account that never taxes the friction away. Apply it to the archetype from earlier. Suppose she now adds international and a small-cap tilt, but still reaching for what feels safe, holds the volatile small-cap fund in her taxable account, and tucks a placid large-cap dividend fund into the Roth instead. She has diversified correctly and placed backwards again. The high turnover asset pays full tax every year in the open. The gentle one wastes the shelter it never needed. Same funds, wrong rooms, and the gap widens another slice. Placed correctly, the picture is clean: foundation, growth engine, international, small cap, emerging tilt. 5 funds, each earning its seat by how much of it the tax code would otherwise consume. The Roth now owns the whole world, weighted toward exactly the assets that lose the most everywhere else. 5 funds in, the ladder looks finished. Any sensible investor would stop here, satisfied the account is built. Which is precisely where the most common mistake gets made. 5 funds in, the account feels complete, and the responsible instinct, the one that has quietly built wealth for a generation, whispers the same next move to almost everyone. Add safety. Add income, add a bond fund, add a dividend fund, lock in something that pays. Consider the archetype one more time. The diligent investor who has done everything the ladder asked. Foundation placed, engine sheltered, world owned. She looks at her Roth and feels a flicker of unease. It's all growth, all volatility, no ballast. So she does what a lifetime of financial advice trained her to do. She reaches for a total bond ETF and a high dividend fund, and she puts them where she believes safe things belong, inside the account she's protecting most. She adds them early, in her 30s, decades before she'll touch a dollar of it. It feels prudent. It feels like the grown-up move. It is the single most expensive gesture in the entire build. Here is the turn. A bond fund's job is to lose slowly, to trade growth for stability, to pay steady interest and go almost nowhere. That interest is taxed as ordinary income in a brokerage account, yes, but the amount is small, because the whole point of a bond is that it doesn't compound violently. Sheltering it wastes the wrapper on an asset that barely grows. The Roth's tax-free forever rule is worth the most on the holding that multiplies the most. Spend that shelter on a bond, and you've handed your scarcest tax advantage to your slowest moving asset. The dividend fund fails the same test for a subtler reason. Qualified dividends already enjoy preferential rates in a taxable account. The tax code was already treating them gently. Locking a large-cap dividend payer inside the Roth protects income that hardly needed protecting, while the aggressive, high-turnover growth that screams for shelter gets crowded out or left exposed. The investor has traded a 2% annual leak she could have plugged for a rounding error she plugged instead. And there's a cost the spreadsheet doesn't show until much later. Bonds and dividend funds added in a 30-year-old's Roth don't just waste the shelter. They drag the account's growth rate down for decades, forfeiting the very compounding the Roth exists to amplify. Ballast belongs in a portfolio. It rarely belongs in the account with the highest expected return and the lowest tax on that return. The right home for the slow, income-heavy, tax-friendly holdings is usually the taxable account or the traditional IRA, the rooms where their gentleness costs the least. This is the layer almost everyone builds in the wrong order, not the wrong fund. Bonds and dividends are fine funds, useful funds, necessary somewhere. The wrong sequence. They get added too early, into the wrong wrapper, out of an instinct to make the riskiest account feel safe. And every year they sit there, they earn less than the growth they displaced, tax-free, on a return that was never going to be large. The seventh rung is not a bond fund rushed in at 35. It is a placeholder held for decades and reserved for later, ballast added near retirement, if at all, and preferably somewhere other than here. 6 funds carry the growth. The seventh waits, deliberately, for a time that may be 20 years out. The failure point is named and paid. What remains is the number. Because when this exact mistake plays out across a full working life, the safe assets sheltered, the growth exposed, the backwards Roth, and the correct one part ways by a figure that has to be watched dollar by dollar to be believed. Start with the number the whole video has been walking toward: $1.2 million. That is the gap between two investors who bought the same 7 funds, contributed the same dollars, and lived through the same 30 years of markets. One built the ladder correctly, one built it backwards. And the distance between them is not a rounding error or a lucky stock pick. It is roughly the price of a paid-off house, sitting entirely in the question of which fund lived in which room. But $1.2 million is a headline, and headlines hide their machinery. Break it open. Take a composite investor, the archetype who maxes a Roth at $7,000 a year and holds a parallel taxable account of equal size, both invested in the identical 6 growth funds. Assume the portfolio earns roughly 9% a year before tax. Inside the Roth, that 9% compounds untouched. No tax on dividends, none on the small distributions the growth engine and small cap funds throw off every year. In the taxable account, those same funds leak. The aggressive, high turnover holdings surrender something in the neighborhood of 1.5 to 2% a year to ordinary income distributions and short-term gains. So the taxable version doesn't compound at 9, it compounds closer to 7. That single gap, 9 versus 7, looks almost trivial in year 1. On a $7,000 contribution, it's a difference of about $140. Nobody optimizes their life around $140. Now let it run. 2% a year compounded across 3 decades of steady contributions is not additive. It is exponential. The tax drag doesn't just cost this year's $140, it costs the growth that $140 would have earned every year for the rest of the account's life, and the growth on that growth. 30 years in, the sheltered account and the leaking one, same funds, same market, same discipline, stand more than $1 million apart. Not from what the funds earned, from what the tax code was allowed to take on the way. Here is what recalculating exposes that the headline conceals. The gap isn't produced evenly by all 7 funds. It is produced almost entirely by the high-friction ones, the growth engine, the small-cap tilt, the emerging market layer. The tax-efficient core barely contributes to the difference at all, because it barely leaks in either account. Which means the backwards investor's mistake is concentrated in a handful of holdings. She didn't lose $1.2 million across the board. She lost it on the 3 or 4 funds she chose to expose, the exact funds the Roth existed to protect, while she carefully sheltered a bond fund and a dividend payer that were never going to move the needle. That reframes the entire loop this video opened with. Does the account change what belongs inside it, or is a good ETF everywhere? The math answers flatly. A good ETF earns the same pre-tax return in any account. That much is true. But after tax, the only return an investor keeps, placement decides everything. The same fund is worth a fraction more or a fortune more depending on the room. The account doesn't change the fund. It changes the keeper's share of it, and across 30 years that share compounds into $1.2 million of difference. So the ranking was never about which ETFs are best. It was about which ETFs the tax code punishes hardest and which wrapper erases that punishment. Once that gap is measured as roughly 7 figures across a single lifetime of the same 7 funds, something changes about how the investor sees those holdings. Selling any of them, the very assets doing the heaviest sheltering, stops looking like ordinary portfolio maintenance. It starts to look like an act of self-sabotage. One investor sells a winning growth fund after a strong year, takes the gain, feels disciplined. Another, holding the identical fund in a Roth, does nothing. And it isn't willpower, it's arithmetic. The first investor pays tax on the sale, then has to redeploy a smaller pile into something new. The second faces no tax bill at all, but also gains nothing by selling, because there was never a tax to harvest, a loss to book, a rate to manage. In a taxable account, selling is a lever. You trade for tax reasons constantly. Inside a Roth, that lever isn't stiff. It simply isn't connected to anything. That is the central truth this whole ladder has been building toward. The 7 funds are never sold, not because their owner is unusually patient, but because the Roth quietly removes every ordinary reason to sell. No tax loss harvesting, no gain deferral games, no rate arbitrage between short-term and long-term. The account strips out the entire machinery of tactical trading and leaves only one question standing. Do you still want to own the world's highest growth assets for the rest of your life? For most investors across most decades, the answer doesn't change. Watch how that unfolds. The foundation anchors and never needs replacing. You don't outgrow the total market. The growth engine, the international layer, the small cap and emerging tilts compound hardest precisely because nothing interrupts them. Every reinvested dividend, every internal gain rolls forward untaxed and uncut. Selling one would mean voluntarily ejecting the exact asset the shelter was built to protect, surrendering the 2% annual advantage you spent 30 years accumulating for no tax benefit whatsoever, since there was no tax to escape. The math makes holding the default and selling the exception that has to justify itself. And so the loop the video opened with closes here. If every ETF grows tax-free inside a Roth, why do only 7 belong there? Because only these 7 lose the most everywhere else. The high-friction, high-turnover, income-heavy assets, the tax code punishes hardest. And the wrapper is worth the most wrapped around exactly them. And why do they never leave? Because the same tax-free rule that earns them their seat also erases every incentive to trade them away. Placement and permanence turn out to be one idea, not 2. The asset that gains the most from the shelter is the asset there is never a tax reason to sell. That is why the backwards Roth is so costly and so common. It isn't a bad fund problem. It's a right fund, wrong room problem, repeated for decades by careful people doing what felt responsible, sheltering the calm, exposing the fierce. Reorder the ladder by tax drag instead of by comfort, and the account fills itself with the 7 assets that belong, in the order they belong, and then holds them, because letting go would mean handing back the 7-figure gift on the way out. Claim it forward or optimize it backwards. Which Roth are you actually building? And would the funds you'd shelter first survive the tax drag test? That is the whole decision, and it compounds either way. None of this is a recommendation to buy any particular fund, and the specific mix depends on a full financial picture no video can see. This is education, not personalized advice. Wealth is built to last, and inside a Roth, so is the reason to hold it. The account doesn't ask for loyalty. The arithmetic supplies it.